Hi, and welcome to Chapter 8 Stock Valuation Part 2. So in this chapter, we're going to continue where we left off in Part 1. If you haven't seen Part 1 video, you may want to watch that first before you continue with Part 2 of Chapter 8 Stock Valuation. So we left off, we were talking about the valuation process. And an important thing to understand to value a stock is what is the required rate of return, meaning what percentage of return do I require given a stock's particular risk in relationship to the average market return? So we can use, this is the capital asset pricing model in equation 8.6. So we could use this to calculate the required rate of return that's going to be needed to compensate me for the risk of a stock. And this is important because we could use this required rate of return to look at either the actual return of the stock to see how closely it matches, or what our future, better yet, our future projected return of the stock. So if we're projecting a stock going to return, say, 5 or 6% in the next 2 years, and looking at the risks, this model says we need at least a 10% return to compensate for the risk, then that's probably not a good investment to make. So let's dissect this formula a little bit more. Okay, so we have the stock's beta here. So this is going to, and we talked about this in the previous chapter, the stock's beta is going to measure the risk or the volatility of your individual stock compared to the market. So if your individual stock is much riskier as far as its movement in stock price in relationship to the movement of the market, it's going to have a higher beta. So higher betas are going to result in higher rates of required rates of return. Now, if we're looking at the risk-free rate, this is currently a rate of return provided by a risk-free investment, typically a treasury bill. Now, the reason we want to break this out, it's normally part of the market return. So the market return is the long-term average return of the stock market. Okay, and this is we could adjust this timing of this average return to be 5, 10, 20 years, depending on how you want to smooth it out. But we always want to take out the risk-free rate because we don't want to amplify it by beta. Since we're multiplying beta, we want to remove the risk-free rate from the market return, then amplify the market return based on beta. Then we can add back an unmodified risk-free rate, meaning we didn't amplify it by beta, to give us a required rate of return. Now, this is again, a forecast, or it's a good way of gauging the risk of a company based on the beta. So it's one way that we could calculate, and this is specifically useful because no earnings are required. So you could use this for companies that don't have earnings. So this is a good way of looking at the risks or the required return where earnings are not present in a company. But where earnings are present and where dividends are present, we can use these other models, the dividend valuation models, to value stock. So we're going to look at those next. And then followed by that, we're going to talk about other approaches for stock valuation. So let's go into the dividend model. So these are very classic models that have been around for a long time. And what they basically were developed in a time where dividends were king. And most of the stock's value was derived from the dividends that the stocks paid. So over the past 100 years or so, dividends paid by stocks have become less of a concern and less of a valuation point. But still, it's important to review these historical valuation models, not that you would use them in today's marketplace where dividends are less significant. So we have 3 models we're going to look at in the dividend valuation model family. We have zero growth model, we have the constant growth model, and we have the variable growth model. So let's look at the zero growth model. This would be where there's no growth in the dividend, that the dividend is going to be the same every year. So assume zero growth in dividends. So you might ask, well, what stocks have a zero growth dividend? I would say the stocks you could probably value with this would be, say, a preferred stock that pays a stated dividend that doesn't change for most preferred stock. And there are also some other stocks that just, state that, the dividend is going to be this for the next 10 years. So that's a rarity, but it can occur. It's a very simple formula. You just take the annual dividends and divide it by the required rate of return, something that we could use the previous formula to calculate. And this will give us what the stock price should be valued at. So and again, there will be a spreadsheet companion video to show you examples of calculating these results. Now, the constant growth is some companies do strive to grow their dividends at a consistent percentage. So they might say, we're going to grow our dividends. We forecast growing our dividends at 2% over the next 20 years. So if we want to calculate the value of a stock price, we can take next year's dividend divided by the required rate of return minus the dividend growth rate. So this is what's going to give us a more accurate stock valuation based on growth rates of a dividend. And this is something that more mature companies, larger companies, will provide a dividend policy that's going to give either state or have historical dividend growth rate. And because companies that are going to be growing their dividends at a particular rate are valuable, and they should have a different formula to denote that there is going to be a constant growth in the stock price. So this is the basic nomenclature of the formula. Value of the stock is going to be D1, next year's dividends, divided by required rate of return minus growth. So what we get here is we can if we escalate D1 to D2, that's the dividend in 2 years. D3, D4, D5 would be the dividend in 5 years. So we can actually calculate the growth of the stock price over time, which is useful. Now, so let's just talk a little bit more about this constant growth dividend valuation model. So we're going to be we have to estimate the dividend growth. Sometimes it could be stated by the management or annual report, or sometimes it could just be a review of the historical payouts of the dividends. And we can assume a growth model based on that historical rate. So we can actually use the average rate of growth of dividends, and we can use a basic present value formula to find the growth rate embedded in the stream of dividends. And of course, we'll go over that calculation in a later time. Now, what is the stock price behavior over time? So the constant growth model is going to say that the stock price is going to grow at a constant, a continuous rate as a dividend, similar to the dividend. So it's making this relationship between the stock price and the dividends growing at a similar rate. Let's look at the variable growth. And the more common situation is you might have a stock that's going to project growth at variable intervals, not at a constant growth, not at a continuous 2 or 3 or 5% growth, but growth at variable intervals. So the value of the stock is going to be looking at the present value of these future dividends in this variable growth phase. So in the formula, which if you remember the time value money formula, this is kind of similar. We're taking each year's dividend divided by 1 plus the growth rate to the exponent of the year. So as we move forward, we go to D2, next year's dividend. We're going to divide by 1 plus R to the second power. And the third year would be D3, 1 plus R to the third power, and so forth. And we're going to be adding all these together. By the end, it's going to be the summation of all these future cash flows. Now, so the variable growth model is going to be, of course, appropriate for companies who are going to have some projected and predictable variable growth in the next number of years, as maybe new businesses come online or new expansions are completed. So we want to estimate the annual dividends in the variable growth period, whether we're looking at 3 to 5 years, how dividends are going to grow. And then we just find the present value of those expected future dividends using the constant growth dividend pricing model for each period. So then we find the present value of these constant growth periods and we add the two values together to get the final answer. So if we look at this, let's just walk through an example here, because it's a little bit more complicated than the other two models. So we have the projected annual dividends. So we have 4 years and we have a projected dividend. So here's this would be the most recent dividend. This would be D0, D1, D2, D3, as if we wanted to put the Ds next to them. And the number notes the years in the future there. So the estimated annual growth rate in dividends for 2022 is going to be 3% and beyond. So we're going to have 3 years of variable growth, and then we're going to have a constant growth moving forward. Okay, so whereas this was step 1, in step 2, we would start off with remember that R is 11% during the initial growth period. So if we want to continue, find the price of the stock at the end of the initial growth period of dividends. So dividends are going to grow at a variable rate into 2021, and then they're going to move forward at 3%. So if we move back here, see that it says here is the dividends are going to grow in 2022 and beyond at 3%. So that means this is the variable growth periods here, and then it's going to be a constant growth of 3% moving forward. So we can use the constant growth model, factoring a required rate of return of 11%. So basically we use that constant growth model where we're going to take last year's dividend and we're going to multiply by 1 plus the growth rate. So 2021 dividend was 348. We multiply that by 1.3%. 3% is the constant growth. We're going to get the dividend in year 2022. And then if we divide by 11 minus 3, or the required rate of return minus the constant growth rate, we get 8%. So if we elevate 2021 dividend by 3%, we get 3.58 divided by 8%. It's going to say that the stock price should go to $44.81. Now, step 4, discount the price of the stock. So here we're going to take, this is the stock price that we're projecting in 3 years, and we're going to divide it by 1.11, which is the growth rate, to the power of 3. And this is going to bring us to a present value of the future stock price at $32.76. So if we add the present value of the stock price to the initial dividend stream, we're going to get the value of the stock. So this would be the value of the stock in today's dollars. This is the value of the stock in future dollars. So we're discounting it back, adding into it the dividend stream, and this is what the value of the stock would be today. Okay. So now the dividend valuation model, this is going to be, we're going to be looking at the expected growth rate. So the aspects of the dividend valuation model, the growth rate is very important, especially over an extended period of time. So G has a big impact on how all these models, except for the zero growth, are going to be calculated. So historical dividend growth of a company is not always the best predictor of future growth. Sometimes managements can help us out in the difference, and management can tell us this is where we're expected to pay the dividend, or they can even make promises. We have the money set aside, and this is the dividends we're going to pay in the next 3 or 4 or 5 years. Now, so if we use this expected growth rate, that we're talking about, and this is pretty well utilized, assuming that the future dividend growth depends on the rate of return of earnings and a fraction of earnings the managers are going to reinvest in the company. So we have to make sure those assumptions are stated by the company or assumed. So G is going to equal the return on equity times the firm's retention rate. So that's one formula to keep in mind. And then a similar equation that the required return would be 1 minus the retention rate would be 1 minus the dividend payout ratio. So if they're constantly, so what it basically means is for every dollar they earn, part of that money is going to be retained, part of that money will be a dividend. So if the dividend payout is 25% of the earnings, then the retention rate is going to be 75% of the earnings. So if we take our retain on equity, times it by the retention rate, we get the growth rate. Okay, so, and again, these models I'll demonstrate in a spreadsheet to kind of show you how they're calculated utilizing a spreadsheet in a separate video. But other approaches to stock valuation. So the market, when dividends started becoming less of an influence, less of a predominance in how stocks were valued, and the dividends paid out started to be disappearing, where many stocks were common for many stocks, most stocks, not to pay dividends. New methods were developed to help calculate stock valuation. So the free cash flow to equity method, or flow to equity method sometimes is called. It's going to estimate cash flows that a firm is going to likely generate for the shareholders. And whether it pays those out of dividends or not, we're not worried about. We can also utilize the PE approach, where we use the stock's PE approach and we relate that to earnings to get a future stock price. So these two methods, we don't have to rely on dividends at all. So let's look at the cash flow to equity. So in this model, we're going to look at free cash flow, how it relates to equity. So let's talk about the free cash flow for a minute. What we're looking at here, what is free cash flow? Well, we take the pile of cash, the cash flow the company makes, and then we want to look at that. We want to take a few things away from that pile to get to the free cash flow. So if we take out all the expenses that the company has, and if we take out the money that the company is going to make for its investments in capital, and in fixed assets, we come up with the free cash flow. So again, here's the formula for free cash flow down here. Earnings, after-tax earnings, we're going to add back depreciation because that's a non-cash charge. Then we subtract the investments in working capital and subtract the investments in fixed assets. So this gives us our free cash flow. Now, if we take the present value of our free cash flows to equity and divide it by the outstanding shares, we get the value of our stock price. So in this model, it depends on how many years of cash flow you want to go out. So when it says ... it just means rinse and repeat. So let's say we can go out 5 years. We would take free cash flow to year 1, 2, 3, 4, 5, add them. First we divide by 1 plus the required rate of return to the power of the year, add them all together, divide by n, the number of years, and we get the value of the stock price using this model. Now, this is going to require forecasting a cash flow to equity into the future, which is difficult. And I would say that probably 5 or 10 years would be sufficient to calculate a pretty accurate value of the stock price. So this is similar to the dividend growth model, except we're discounting free cash flow rather than dividends. So this is why this model would work for a company that doesn't pay dividends. So going back to the dividend growth model, we can assume free cash flow remains constant over time, growing at a constant rate, or growth at a rate that is variable over time. So, we have 3 scenarios. Basically, there's a 0 growth in the free cash flow, which is unlikely. There's a constant growth in the free cash flow, which could be negative or positive, but hopefully positive. Or there's a variable growth in the cash flow, depending that the business doesn't grow evenly, grows differently over time. So probably the variable growth in cash flow is the most realistic of the models. Now, we're going to use what's called the internal rate of return, which is the IRR, to solve for the expected returns. So most investors prefer this internal rate of return. Some points here, some investors prefer to find the expected return of a stock's given its current market price rather than its estimated stock's intrinsic value. There's a trial and error aspect to finding this discount rate. So when I say discount rate, that's the same as saying internal rate of return. Because we want to find the rate that's going to equal the present value of the company's future cash flows, which basically, when we find the discount rate that equals the present value of the company's cash flow, we've in fact found the internal rate of return. Okay, and then once you estimate the stock's required return, we can judge or decide whether that's sufficient given the risks to invest in the stock. So let's look at the price to earnings, the PE approach. This is a pretty common approach. Most security analysts like this approach, and we simply take the earnings per share. Well, if we look at any stock price today, the earnings per share is going to be multiplied by the PE ratio to get the stock price. So if we could forecast next year's earnings per share and next year's PE ratio, we can get next year's stock price to project the earnings. Okay, so again, if we think earnings next year are going to be $3 and the PE multiple is going to be 10 next year, the stock price next year should be 30. And this is a great model, but it's sometimes difficult to project earnings per share and sometimes difficult to project the PE ratio moving forward. Those are the two drawbacks of that model. But again, what's great about the model is you don't need dividends. Okay. Other ways that we can value stock is we could look at a price relative to other indicators, other procedures. So the PE approach and other price related procedures, we can get like a baseline of the valuation to figure out what the value of the stock related to its performance characteristic. So we could look at the stock price related to its cash flow, which would be the stock price divided by cash flow ratio. We could look at the stock price related to sales, or the price to sales ratio. We could look at the stock price related to book value, or the price to book value ratio. Now, this is again you can use these multiple sort of build up, calculate the average for the industry, and then see how your stock fits in. So we can calculate industry averages for price to cash flow, price to sales, price to book, then calculate your stock's individual values to see whether it's over or under price compared to the market. And again, this just gives us sort of a way to anchor the stock to a couple relative terms to see how the stock is valued compared to its peers. Now we have the price to cash flow procedure, which we would say price to cash flow. So it's the market price of the stock divided by the cash flow per share. Now this is tricky because we have to now be estimating, we know what the current market price of the stock is, but we have to estimating the cash flow per share from operating is, can be difficult, not impossible. Now, you can also, some people might use the free cash flow or EBITDA as the cash flow per share. It's really up to your preference. But they believe that the cash flow is a more accurate way of predicting a company's true value than net earnings. And I would say that's true because net earnings is typically highly modified because we're trying to reduce our net earnings to pay less taxes. So net earnings can be manipulated in a way to try to make companies them look smaller to reduce their tax burden. But cash flow isn't manipulated in that way. So cash flow is a little bit more pure of a number to look at. It's less manipulated. It's a more true representation of the company's value. So that's why this cash flow, price to cash flow approach sometimes is a little bit more, investors feel a little bit more accurate. So let's look at the price to sales approach and the price to book approach. So similar to the PE approach that we talked about earlier, but we're going to substitute sales instead of book or book value instead of the PE multiple. Now, if companies have no earnings, these are two great models for judging value. So if we take the stock price, when it says market price of common stock, this just means the stock price. Stock price divided by the book value per share. And we talked about this in last chapter a little bit. So the price, the book value per share would give you an idea of how valued the stock is. So this should always be greater than 1. But some stocks, if they have a very high price to book value, they can be overvalued compared to their peers. And so that's the critical thing, is you have to look at similar peer companies in the industry to see the relationship. Are they more valued or less valued than their peer companies? And then if we look at the market price of common stock, the sales per share, we can get an idea of the multiple of stock price relationship to the sales per share. Now, this could be useful. So if you line up, say you have 10 companies, you take them in a period of time where they had growing sales but no profits, and kind of see what was the average PES ratio on these companies that had pretty accelerated growth in sales but no earnings. So when we come across a new company that might be growing quickly with greatly increasing sales but no profits yet, we can kind of see how did this company's currently at a 10 price to sales ratio. What if peers in their similar growth stage of life, what were they at? So again, it can give us a grounding of, are investors getting ahead of themselves paying for this growth in sales? But I also think with this model, you should also think about the company's ability to convert those sales to profits in the future. What is the company doing that's going to make those sales more valuable in the future? So growing sales alone isn't enough to buy a stock. It has to have the potential to convert to profits. So say, for example, Amazon. For many years, Amazon all they had was growth in sales and no profits. So why were investors buying the stock and continuing to drive the stock price higher? Is because Amazon had a plan for converting sales into more profits. And that plan was efficiency. We're going to make fulfillment centers. We're going to make a better delivery system. We're going to control costs. We're going to, organize and distribute our inventory in a way that we're going to get more profits out of selling items. At the same time, we're going to move into other businesses like cloud computing, and also Prime memberships, to also greatly increase our profits. So they had a plan for profits. So when investors are confident that the company has a plan for their sales to turn into a higher percentage of profits, then of course that stock's going to be more highly valued than a company. No one's going to want a company that always increases their sales but has no plan for making a profit. So when we look at all these valuation models, we have to really take into account management's perspective and management's guidance on the company. And that's key to a lot of these valuation models, is how is management guiding dividends? How are they, what are they saying their projections for dividends are? What are their projections for sales? What are their projections for developing profits in the future, their plan for developing profits in the future? So all these things have to be in the back of mind of investors, because the truth is no one mathematical formula is going to give you the accurate value of the stock price. It's going to be a combination of these formulas to give you, these formulas are just artifacts. These are just valuation artifacts to give you an idea. Okay, here's points of data that consuming that gives me an closer idea of what the stock price should be. So as you're consuming more of these points of data, along with the management's philosophy of the company, along with the track record of the company's products, along with the competition in the market, along with the regulation for the market, all these things sort of have to come together. So it's a multi-point analysis to develop what you think the stock price is going to be in the future. So no one formula should be utilized to say this is what the stock price should be, and buying and sell based on that one formula. You want to use as many points of data as possible, and hopefully this will tell a story of where the stock price should be. And sometimes that works out. Sometimes these valuation models, your valuation approach can be very way off, because you're betting on certain things to occur, which may or may not occur. Such as if you're looking at cannabis stocks and you're thinking that, okay, these stocks are going to take off as this is legalized and becomes more readily available through distribution to the general population, these stocks should greatly improve in their sales and profits. And that was probably true unless the federal government takes a stronger stance against it, unless certain states never legalize it, unless the federal government never legalizes it. These are things that you don't know. You're expecting these will happen, but you're not sure. So your valuation models are based on this one key piece of information that if you're wrong about it, things are going to go in the other direction. So it's a difficult process to value a stock, but the best advice I can give you is experience in valuing stocks over a long term, the lifetime of experience that you develop as you begin this journey, this process, and you look into valuing stocks and you think about all these different things and you trial and error and you learn from your mistakes. Eventually you get to a point where you become better at predicting stock valuations based on your years of experience, some of your intuition of how markets react, and seeing patterns where certain new up-and-coming companies do mirror companies that have come before them. So there's a lot of trends or cycles in the market that you start to understand better as you become better at valuing the future of stock prices. Okay, so that's it for part 2 of chapter 8. I look forward to talking to you in chapter 9. Take care.